Good morning, Bix Weir, roadrooter.com with your morning news, your morning Horn of Z's. Really exciting time for silver investors. It's looking more and more like the bottom is in for silver, which is great. The bottom of the rigged system, rigged manipulation, is even looking like it's bottoming. Interesting stuff coming out of Asia, and I want to highlight a certain company that is failing due to its probably derivative position, and it's a huge counterparty for a lot of these commodity derivatives. But first, let's talk about silver. Zero hedge this morning or yesterday. Silver surges as shorts hit 2-year high. Very important that the shorts are high at the bottom of the silver market, because it adds fuel going up. As the short players cover their shorts or attempt to cover their shorts, that's where the real fuel comes from on price rise. It's not from buying, it's from covering of shorts. And then when you add leverage to that, it gets really ugly. So that's really exciting. But let's talk a little bit about this. The so-called smart money has been piling into short silver positions in the last few weeks, creating the biggest hedge fund silver short in 2 years as of last week, as silver rebounds from a record losing streak. The last 2 times hedges were this short, silver managed notable gains, and that's exactly what I was talking about. When the big shorts try to cover their short positions because silver moves in the opposite direction, they panic because they're all leveraged. And so they got to buy back as fast as possible, and that's where the fleecing comes in by the banksters and those in the know who can cause this action to happen. But let's look at, there's the silver futures short position. Remember, this is all derivatives. It's got nothing to do with physical silver. But this one might actually, so let's talk about it. And then it says, it appears that after a record-breaking streak of losing days, amid what may have been forced liquidations from Noble Group. Now the question is, were they forced electronic liquidations of positions, or were they forced physical metal? I would venture to say it was on the electronic side. Although Noble Group is a physical commodity player, the third largest commodity player behind Mark Rich's 2 criminal enterprises, Glencore and Trafigura, which I will talk about in a second here. And here we have the price graph relative in the last couple days between silver and Noble Group, and as you can tell, Noble Group is diving as we speak. Huge derivative player in commodities, huge silver player in the derivative market. So this might be a very focused attack on a gigantic silver player by the good guys, I would assume, if it's being allowed to happen. And I'll show you in the next couple of slides why it is being allowed to happen. $16 has brought back the buyers, and perhaps Noble Group has ceased its commodity liquidations. When it says commodity liquidations with a commodity trader, it could be physical, but the real movement comes from electronic liquidations. Perhaps Noble was electronic long and was selling all up into May 8th, and then the bottom was in, they stopped selling, and silver price was allowed to rise. Very interesting stuff. But let's go back to a year ago where the same thing was happening. Noble Group was in deep trouble, and same with Trafigura and Glencore, and it was believed that China and Deutsche Bank was involved in this as well. It's believed that China bailed out the silver manipulation and gave the system a few more months / years, year and a half now, since the last time these guys were in trouble. But they're back on the table, so it's all signs are pointing to chaos coming to our market, especially in the silver market, which is the bank killer. Remember that. They'll do everything they can to control that market. Anyway, here's what I said last year on Noble Group, all eyes on Noble Group. I have highlighted the commodity trading companies Glencore and Trafigura in several postings over the past few months. These companies are the physical manipulation arms of the market rigging machine. Yes, the price rigging is all about using computers to rig the electronic exchanges, but there is also a physical rigging operation that must take place behind the scenes for the electronic games to continue. When it fails to work, the bad guys find themselves in a situation where they are holding a massive amount of electronic metal derivatives with very little physical to be obtained. This is a recipe for a market meltdown. Glencore and Trafigura sprang from Mark Rich's trading company, which was at the heart of all commodity manipulations in the 70s, 80s, 90s, and 2000s. Yes, it's the same Mark Rich that Bill Clinton pardoned from his 1983 indictment of 51 counts of tax evasion, racketeering, and fraud. He was on the FBI's most wanted list for close to 20 years, and that's a very long time to rig markets. For my past analysis, do a search on Roto-Rooter for Mark Rich. Very important. I have a ton of information, and read the book called Metal Men. If you want to know how commodities are rigged from the physical side, you need to understand Mark Rich, who he was, who he's connected with, and how he rigged physical commodities for the bad guys and the good guys. He was basically a market rigger for hire, the physical market rigger for hire. Clinton hired him. That's why he dropped all charges against Mark Rich. It wasn't because Mark Rich gave Hillary Clinton some furniture. I think that was the story. No, it's all about the strong dollar policy and how that was achieved in the 90s through the Bill Clinton administration. They had hired Mark Rich to rig the commodity, the physical side of the commodities, and then had the Fed and the banksters rig the electronic side. Really interesting stuff. If you're interested in how it works behind the scenes, learn everything you can about Mark Rich. Mark Reich is his real name. And also, there's the Roto-Rooter website. If you guys haven't, see this portion right here, subscribe to get a free book. Put your name and email in. I put an email announcement last night about this situation with Noble Group, and you can just stay on top. I'm going to do more and more email notifications. So it's not just YouTube that's going on these days. So very important. Put your name in, put your email in, get a free book. And there's book 2 also. If you go to the home page right here, and third one down, first one right at the top, free copy of book 2, Out of the Darkness. So join the Roto-Rooter and find out what's going on behind the scenes with silver and gold and the Trump administration, the take back of our country, and the destruction of the bad guys. Anyway, so here's where we are today. Now, I wrote this about Noble Group. It was the last time they were in trouble, which was last year, January. It really started of last year, along with Trafigura and Glencore. Those are the 3 largest commodity derivative players on the physical side and on the derivative side. They're the guys who really do own and move metal. Very important, but they're huge derivative players, some of the biggest besides the banks, and they work closely with Citibank, JP Morgan, and Deutsche Bank to rig the markets. All right, Enron 2.0, Asia's largest commodity trader, halted after crashing to 16-year lows on S&P downgrade. This was posted last night. Once Asia's largest commodity trader, Noble Group, has been halted after crashing almost 30% this morning following S&P's lowering of its corporate debt rating to CCC+, citing continued weak cash flows and profitability. Remember, S&P works for the U.S. government, so when they downgrade anybody, it is on purpose. It is a direct attack, and that's what it is, triggering all kinds of derivatives in the background. And like I said, the U.S. is ready to end this game, so they're going to attack the weakest spots and the most vital spots, such as physical metal manipulation. Quote, "We downgraded Noble because we believe the company's capital structure is not sustainable." Quote, "The negative outlook for Noble reflects the potential that the company will face distress and a non-payment of its debt obligations over the next 12 months. And you can see Noble Group has crashed. This is a direct attack at the heart of the bad guys. If you attack the derivative, the commodity derivative market, you are you're throwing gasoline on a situation that is already very, very volatile, and it doesn't take much to crash it. So let's see what else they say. This has been coming for a while, as we warned a year ago, and I was talking about a year ago as well. The Enron moment. Our balance sheet, the strongest in recent history, represents a significant advantage as we continue to identify high-value growth opportunities across the products and geographies we operate in. Maintaining our investment-grade rating with the international rating agencies is a vital part of the strategy. That's what Noble Group said in 2014, and now they've been downgraded. And then in 2015, Moody's Investors Service has downgraded Noble Group's limited senior unsecured bond ratings to Baa1 from Baa3 at the provisional rating on its senior unsecured MTN program. That was Moody's in 2015. And then now we have just this year, or no, that was last year, Noble Group downgraded to BB plus on weakened liquidity, and now we have this huge downgrade to junk status. To where do they get downgraded to? CCC plus. I think that's one notch above junk, or that might be the highest junk. I don't remember. My banking days are so far behind me, but it's not good. And it triggers a lot of contractual obligations, collateral calls, things like that. So very interesting. The story of Noble is worth writing a book, mostly how not to run a business. If they are in this mess, it is in large part because the management was comprised predominantly of traders who were predisposed to defend their books. Noble has been desperately trying to revive their image by hiring former Goldman, JP Morgan, Trafigura executives, etc. By doing so, they were looking for a form of credibility collateral. Oh my God. It doesn't work well for the new employees, as they rapidly found out they inherited some of the liabilities of 1 decade of Noble's poor decision making on the hardcore asset guys like William J. Randall and ex-Goldman Sachs bankers Youssef Alirez. In the part 2 of this analysis, we will review the gap between liquidity headroom and the debt maturity profile of the trader and explain how Noble Group will have its Enron moment. The fatal mistake that Noble Group did was apparently to mislead the market about their financial performance, presumably by using accounting devices. Derivatives, basically. Anybody can cook the books. It's called financial engineering, and they teach it in college, believe it or not. During last November, Noble's chief financial officer, Robert van der Zalm, has stepped down from his position after taking a leave of absence for, quote, health reasons. 2 months later, Moody's downgraded Noble Group. In a very awaited decision, S&P has finally lowered Noble Group to junk, placing Asia's largest commodity trader on watch for further possible downgrades as the rating agency remains skeptical about the liquidity headroom of the trader. And there you see, equity market is roughly linear. Models aren't. According to Noble Group, on September 30th, 2015, the company had $15 billion in banking facilities and a $1.668 billion in RMI, readily marketable inventories, meaning silver, physical gold, oil, all commodities. And that's the question, is where are they pricing them? How are they pricing them? As we know, silver has been slammed down, so was this part of the problem? Did their 1.7 billion go down by half? Who knows? 11.1 billion of these 15 billion banking facilities is committed and are contingent upon the ability of making investment grade rating in the future. So that is now being called into question, most likely collateral calls. Noble claims to have 900 million in cash and 1.7 billion in readily marketable inventories. Their 1.7 billion in RMI have claims on related party notes that are under collateralized by their commodity merchant activity and therefore should be excluded from their liquidity headroom. Noble Group currently uses 3.4 billion of borrowing facilities that are uncommitted. Noble Group is left with only 1 billion of unutilized committed borrowing facilities and 900 million of cash ready available to meet about 3 billion of debt scheduled in the next 12 months. Basically, when this information comes out, no bank will lend to them, and every bank that can call in a loan and call in the collateral is going to do so right away. So yeah, basically the downgrade was the death, the final nail in the coffin. Here's a chart of the liquidity, access, and debt profile in the last 12 months. They owe it, well, in the next 12 months, bank debt they owe $2.5 billion, and senior notes $458 million. So as of September 2015, within 1 year, it was that was the old one. Okay, $2.9 billion. Moreover, Noble Group counts on the competition of Noble Agri stake divestiture to reap $750 million in transactions that may not be completed by January 16th, or February 2016. It didn't get finished. Okay, so what we have here is the breakdown of poor Noble Group and how it got in such a very poor position, and it's using leverage to play the commodity markets, and that's how the big players do it. And when it goes bad, it goes really bad. So let's look at the part 2, and this is actually from January of last year, the first downgrade by Moody's. And the problem back then was exactly what it is saying right here. Collateral margin calls. The trader has billions of dollars of commodity prepays with NOCs and producers, and the value of inventories and receivables collateralized by traders into trade finance arrangements have created in the past year. The collateral value of Noble Group is being depressed, and those loans are being called, even if Noble Group, buoyed by liquidity in 2015, never missed a payment because the market knows that Noble's assets are worth less than they claim on their books. Basically what happens is, this is the anatomy of a collateral call, and it really gets triggered in when contractually they become required to either cover some of the collateral that is being asked for by the banks, or sell their inventories to pay off the loans. The problem is, with the low price of commodities, every commodity trader will tell you that if you sell, you don't sell low, you try to buy low and sell high. They should be doing exactly the opposite, but they are being forced to sell now that, as of May 22nd, 2017, Noble has been downgraded, and this is the implosion of one of the largest commodity players in the world. The big question is not what kind of inventories they're going to be selling off. The big question is, what kind of derivative book do they have? And it's going to be in the billions and possibly even trillions in commodity derivatives. So that's where we stand. And Trafigura and Glencore are next on the list, I would assume, because there's going to be third-party problems with derivative contracts. And then chuck in there Citibank, JP Morgan, and Deutsche Bank, and you have a toxic cocktail for our commodity markets over the summer. So just hang in there. Based on the current hedge fund short position, now is a great time to buy physical silver. Get out there and load it up. We are pretty much at the bottom. If you can get silver around $17, load up the truck, back it up, load it up, because it's not going to be available. It's going to change very fast, especially as all the hedge fund managers try to cover their short position. And remember, you need a seller. If you're gonna cover, you got to go out and buy, and when the buying happens in mass frenzy, you got to make sure there's a seller, or you're not going to be able to cover it. It's kind of like stop losses and things like that. If there's no one at the other end of that transaction, it won't get filled. And I think a lot of the players in the physical silver market are saying they're not going to sell until at least silver gets well over $20. So lots of room for excitement, and I don't think it'll stop at 20 at all, especially with the other chaos going on around the world. So yeah, now's a great time to load up on physical. This is Bix Weir, roadtoruta.com. I have a interview with Sean at SGT Report this morning, so we'll get that out as soon as possible. I'm sure we'll talk about some of the more exciting conspiracies going on, and we'll talk to you later.